Welcome back to Veronica Live, and we're here with our next guest who can talk money with us, and that is Russ Koesterich. He is BlackRock's portfolio manager of the BlackRock Global Allocation Fund, and we are so thrilled to have you back on the show, Russ.
Well, thanks, Veronica. It's great to be back, and good to be back with your listeners.
Well, and money impacts all of us every day. So, we definitely wanted to talk about the job market, and I know you're an expert in jobs. So tell us where we're at, because I know that they just released. I guess we're doing well when it comes to hiring people.
We are. It's been a remarkably resilient economy, and no more than any area than in the labor market, in the jobs market. We're still creating a really solid number of jobs. Wages are growing at a reasonable pace, at least relative to inflation. And this has surprised a lot of people. I remember a year ago, there were a lot of calls that there was going to be a recession, that the economy was going to turn lower, and it hasn't happened. And part of what's happened is that a lot of people that left the job market back in 20 and 21, particularly nurses and teachers, they've been slowly coming back into the job market, and that's helped quite a bit.
And how, the other word we keep hearing all of the time is inflation. And John and I talk about this all the time because we go to the grocery store, and the other day I was in our lovely Publix, and a silly pot roast was $29.
Whoa!
For a silly pot roast. So how does this impact Americans now that are trying to have a job, and then inflation's out of control, and our jobs, are they really paying more money these days too?
Well, this is a great question. This is why, despite the fact that the job market is relatively strong, confidence is not as good as it could be, and it's precisely for the reason you laid out. Prices are higher. Now, this is kind of a glass is half full, glass is half empty story. The good news is prices or inflation, they're rising at a slower rate than they were, call it 2 years ago. So the rate in which that pot roast is going up is slower than it was in 2021. But, as you point out, that pot roast is still a lot more than it was back in 2019. And I think this is where people are understandably frustrated, that the price for a lot of things, whether you're talking about food, rent, the cost of going to a ball game, that's all a good deal higher than it was 4 or 5 years ago. And, that does impact the way people view their economic situation.
Russ, one of the things I'm curious about is how much this is being driven by government spending. I mean, I look at the economic forecast, listen to Jerome Powell, talking about these deficits, running multi-trillion-dollar deficits for as long as that I can see, and we're pumping so much money into the economy. Is my economic training or whatever schooling has always been, if you pump a lot of money into the economy, you're going to get inflation. And they tried doing that for a long time, and all of a sudden, here comes this inflation train just speeding through. Is that really what's going on here?
It's definitely a part of it. It definitely is. It's really hard to kind of disentangle, the role of government spending versus, how much money the Fed put into the system back in 20 and 21 versus the fact that, 3 or 4 years ago we had all these problems with supply chains, and there were, cargo ships that couldn't dock in Long Beach. But I think you're right. There's definitely a component of this which comes from a lot of money being spent by the government, and just to put numbers behind it, we're running deficits. Again, the difference between what the government takes in taxes and what they spend, that are equal to 6 or 7% of gross domestic product, everything that's produced in the country. And we've never seen that level of deficit spending outside of either a recession, which we're not in today, or a war, a major war. So this is unprecedented. And while you can't give the exact number, I think it's fair to say that the amount of government spending and the persistence of government spending has contributed to this environment of higher prices.
So do you think to me it seems like the prices are now baked into the economic formulas, and do you think that there's going to ever be a potential for disinflation, or if the Fed would allow a disinflation period in order to get prices back down?
So I think we are going to see some disinflation. As a matter of fact, we're already seeing it, but it's very specific to certain categories. So I'll give you an example. Certain prices, if you look at around the holidays, were coming down. The price of toys, for example, was coming down. Parts of apparel, clothing were coming down. So there are areas where there's a lot of inventory, where merchants are like, look, I've got more exercise equipment than I need. I've got more pairs of jeans than I need, and we can discount those. Where you're not seeing that, and this is where I think the Fed the central bank is a little bit nervous, is in a lot of services. Anyone who's gotten on an airplane recently or stayed at a hotel or gone to a restaurant knows that prices have not come down. They're still a good deal higher. So that's where we're not seeing disinflation. So part of the challenge right now is you've got parts of the economy, particularly goods that we buy, where prices are falling. But then you've got a lot of what we buy in services and experiences where they're still rising at a decent clip.
So on the real estate market side, I was reading in the Wall Street Journal about all this office space that's being vacant office space that's being carried on a lot of as still performing loans, and that there's a good potential for another equivalent of a housing crisis that we saw in 2008. Do you see that on the horizon?
We do think there are problems in the commercial real estate market. And again, this would be office buildings in particular. We're more constructive on the housing market, which, as you know, was what really, kind of crushed the economy back in 2007, 2008. And the reason is we've got a shortage of houses, particularly in many parts of the country where you can't build as easily as perhaps you should be able to. So we're less worried about the housing market, but we do think that commercial real estate, particularly office space, is a problem. For a bunch of reasons, one of which is a lot of those properties, a lot of those projects, they might have made sense when you could borrow for almost nothing as you could in 2019 and 20. Rates go up, and suddenly, a project that was profitable when you could borrow at 4% is a lot less profitable when you're borrowing at 8%. But the other problem is, as you all well know, is that there's been a lot of migration, and there are parts of the country where people have just not returned back to the office, whether that's New York or San Francisco. And in those markets, you do have a lot of office space that's lying empty and may not be viable going forward. So I don't think it's going to be as bad as 2007 and 2008, but there are smaller and regional banks that are tied to those markets. We've seen one, for example, New York Community Bank Corp, that are under stress because of this problem with commercial real estate.
So, people talk, Russ, about recession. Do we need to be worried about that going forward? Because that word always pops up in every business story inflation, recession, and economy. Those are like the three words.
I think that's totally fair. Veronica, I think the good news is we're probably not looking at a recession this year. Because,
Great.
Again, the job market is strong. Consumers, again, I know people are not feeling great, but they're certainly in decent shape. People have less debt than they used to in general. Doesn't apply to every household. Inflation is slowly coming down. There will be another recession, no doubt about it. But it's funny, a year ago, that was the word of choice. You looked at Google searches and the searches on recession was skyrocketing. I think there's less concern about that today. It's one reason the stock market is doing a lot better. It's one reason that confidence, while it's not great, is up from where it was 6 months ago, that people are feeling, we're probably going to be able to avoid it, at least in the near term.
Great. Well, I love hearing that. And what about our housing market? Because the interest rate to buy is that's more insanity, especially for young people trying to make it today.
Well, that's the tough thing. If you've got a home and you have a mortgage that you got 4 years ago and you refinanced it at 3%, you probably want to stick in that. You want to stick in your house because it's hard to get that same financing on a new home. So what we're seeing is that, people are they're not selling. There's not a lot of turnover in the housing market. And you're exactly right. If you're a young person and you're starting out and you're looking at a mortgage of 6.5% or 7%, that's a much harder payment to make each month than back in 2019 when that same mortgage might have been 3.5%. So what we're seeing in the housing market is just not a lot of turnover. But I think there's a solution to that. And what you're seeing is people moving to parts of the country where housing is cheaper, where you can add supply, where you can build. And I think that continues. And some of these migration patterns that have really been, so powerful over the last 4 years, I think you're going to continue to see that happening. And, obviously your state, Florida, has been, one of the biggest beneficiaries of that.
Very, very true.
I'm just curious, Russ, on the economic models, are they being adapted? We have like at least 8 million people that have come into the country in the last 3 years, and I don't want to make this a political discussion, but that I'm looking at the economic impact, because you have 8 million people come in. You obviously has demand for housing, healthcare services, jobs, everything else. Are the economic models designed to have that kind of number come into it and make reasonable predictions?
Probably not. I think is the short answer. Economic models are, they're useful, but they're models. It's trying to represent this huge economy, which is made up of 330 million people and billions of transactions with a couple formulas. And, that might be helpful to get you in the ballpark, but there's always going to be things you leave out. And, one thing I learned early in my career, economics is not physics or engineering. You have an engineering model, you kind of trust it, that bridge, if you build it right, is going to stay up. Economic models, there's a lot of guesswork, there's a lot of assumptions. So, no, I think the reality is they do tend to leave out a lot of things, no matter how good it may be or, how brilliant the person who invented it might be.
Well, my daughter's a Wall Streeter, so all week I was talking to her, and I was like, I need you to send me a question or two. So she asked me to ask you here, based on Friday's PPI print from Larry Summers, he said that the Fed might need to hike again. What do you think that does with the Fed's timeline?
I think it pushes back on what a lot of investors thought 3 or 4 months ago. So just to take a step back, if we go back to around Christmas time, the market had convinced itself, and you can see this in various financial instruments, that the Federal Reserve was going to do their first rate cut in March when they had one of their scheduled meetings. And they were going to keep cutting maybe 7 times over the course of the year. And the funny thing is the Fed said, we're really not going to do that in their speeches and various officials, but the market didn't believe them. And what you've seen over the last 3 weeks is the market is starting to take the Fed at their word, which means they probably will not begin cutting rates until late spring or more likely early summer. And when they cut, they're more likely to cut 3 times rather than 6 or 7. So the importance of that is, short-term rates, short-term interest rates, which are set by the Fed, are probably going to be higher at the end of the year than most investors would have thought 2 or 3 months ago.
And I had a question as well, because, we've got Ukraine and we're giving money to them. And, how does that impact when America gives away so much money? And how does that impact the world that you're living in? Is that something that you're thinking about when we have wars overseas that we're either involved in or supporting?
Well, it is something you definitely think about. And certainly, we've got 2 wars going on right now in the world. That are affecting everything from the price of oil to whether or not you can get a container ship through the Red Sea. So you've got to be aware of all of this. But I think it's very hard. And, one thing you asked before about, how good are economic models? They're as good as they can be, but they're certainly nowhere near perfect. I think it's also really hard, given all the uncertainties in the world, for someone to know what's going to happen ahead of time in the Ukraine, in the Middle East. So when you're building a portfolio, you're investing for clients, you've got to ask yourself, well, what could go wrong? And if something does go wrong, how can I help protect our clients from some of the bad outcomes? But there is a lot of uncertainty right now. And just like it's hard to build a model to capture immigration, I think it's really hard to build an economic model to try to predict what's going to happen in the Ukraine.
Okay. And I had another question, because this week there was a senatorial candidate in California that wanted to, she said she wants the minimum wage to be $50 an hour. And that just That just seems insane to me, especially for the small business owner when it comes to jobs. They're not going to be able to afford this. Is that crazy when people, want to hike the minimum wage and, to $50 an hour? Because we've had $15 and, so.
Yeah, 50 is aggressive. I don't think it's a bold comment.
Sign me up. New Starbucks barista.
Today, it's hard to go from 15 to 50. That's a big increase. And look, no one knows what the right number is, but it does have an impact, and you always have to ask, how is this going to affect the demand for labor? And there's always a question. You raise the price of anything. And in general, and it's common sense, you don't need to take an economics course, the demand goes down. So you raise the price too much of hiring an entry-level worker, you have to ask the question, well, are people going to want as many of them, or can they afford as many of them if you really aggressively raise the price, bringing someone into your labor force?
Well, I wanted to add, go ahead, John.
I was just saying, in general, Russ, do you think the stock market is overpriced, and same thing for equities? Or do you think the pricing is where it should be, and where are we going?
Not for every stock, but in general, I do. And it's John, this is a great question. And if you look at sort of the basic valuation metrics that people tend to watch for the stock market, it's not cheap, and it's hard to make an argument that it is. But I'd say a couple things. The first of which is you've got a few companies. These days they're called the Magnificent Seven. They used to be called the FANGs. But the gist is you've got a few really big tech companies that just have a phenomenal business model. And they just generate, billions of dollars of cash. So yes, they're pricey, and some of them may be overvalued, but generally they're such good businesses, you can make an argument that you want to pay up to get a part of that. And the funny thing is the rest of the market, when you look at a lot of segments from autos to airlines to energy stocks, they're actually quite cheap. And the reason is, last year while the market was up 25%, which was a great rally, particularly after 22, a lot of parts of the market were left out. So we're still finding bargains in the stock market. We still think that for long-term investors, you don't want to abandon it. You might have, some bumps along the way this year, but we still believe, particularly with decent growth, with inflation still too high but coming down, that stocks can end the year higher than they are today.
Great. And then here's another question from one of my experts. CPI came in hotter than expected. Where do you think this leads the Fed at starting the cutting cycle?
As we were talking about a moment ago, I think it leaves the Fed taking their time. Because the Fed is looking at the economy and saying, well, you know what? Generally when the Fed cuts, they're going to cut because they're worried about the economy. And right now, there's not a lot of reason to worry about the economy. And the Fed could also say, well, you know what? We think the economy is okay, but inflation's coming down, and we don't have to keep interest rates as high as they are. And that's what we expect to happen later in the year. But as your listener correctly points out, inflation's not coming down as fast as maybe they'd hoped, and a lot of investors would hope. So what it tells the Fed is, you know what? We did a lot of work to get rates where we think they need to be back in 21 and 22 and 23. We're going to wait now. We're going to hold off. So I think it leaves the Fed waiting and probably not doing much until we get into the summer.
Excellent. And Russ, what do you actually do for BlackRock? Because I saw you oversee $50 billion in global assets, I guess. So tell us what you do, because that's amazing. That's so much money that you're overseeing.
It is a lot of money. It is a big responsibility, which we hopefully can deliver for our clients. But my role is I'm a portfolio manager, and along with a couple of my partners, we manage what's known as the Global Allocation franchise. And what that is, these are a number of different funds in model portfolios that basically are designed to give people, their whole portfolio. So we invest in stocks, in bonds, we can invest in commodities, and we've got a lot of flexibility to think about, for someone who might be saving for the next 30 years, what portfolio, what can we own in the market that's going to give them a good rate of return over that period. And hopefully, doesn't always work out that way. 22 was a tough year, but hopefully give them a bit of a smoother ride, dampen down some of the volatility that people sometimes experience in financial markets.
So Russ, you have a global perspective. Do you see any other economies tracking or bettering? I mean, are we looking at something like the Asian countries? A couple of decades ago, that was the big thing. The decade of the Asians was growing, and that's where you should be investing. Is there any equivalent to that we're looking at now, like South Korea, Japan, again, Australia, New Zealand, any of those?
There are a couple of opportunities, but I'd say, first and foremost, we do believe the U.S. is the best market to invest in right now. And if you look at our portfolio, U.S. equities are our biggest holding. We have more of them than our benchmark, which we're measured against. So we're definitely long the U.S. What I would say is, we've pulled back quite a bit on China. I don't think that opportunity is nearly as interesting or as safe as people might have thought 10 years ago. But the direct answer to your question of where there are some other opportunities outside the U.S., I would cite Japan. Now, with Japan, it's a funny market, and it's a market that's disappointed investors for a long time. And as many people will know, the Japanese stock market peaked up 35 years ago in 1989. So it's been treading water for a very long time. But having said that, it's been doing much better lately, and the economy is normalizing a bit. They have less deflation, which they were fighting for years. Their corporations are getting a little bit more friendly to shareholders. So the other market we found interesting right now is Japan.
I love Japan. Well, that's excellent. And, you're dealing with these big clients, but somebody just starting out, do you have any advice for, somebody just joining the military or just out of college? How do you get ahead these days when your rent prices are so high just for your little apartment?
Yeah, no, it's a hard thing. And again, you definitely have to, you got to realize that for a lot of people, just trying to pay their expenses, there's not necessarily a lot left over. Mm-hmm. I'd say start small. You know what? Even if it's, $20, $30 a month that you can put away towards, whatever investment you're comfortable with, hopefully a broad one that includes some stocks, just get in the habit of putting that $20, $30, $40, $50 away. And over time that will build. And, the one thing that young people have going for them is time. And, it's pretty miraculous. You think about, getting a 7 to 10% return over 40 years. You can start small, but if you keep at it and you keep that money invested, by the time you're looking at retirement, that's a pretty significant nest egg. So just invest what you can, do it for the long term, and stay in the markets.
Excellent. And what are we missing, Russ? Because I feel better now talking to you. I guess I can afford the $29 pot roast.
I'm still reeling over that number. That is a lot for a pot roast.
I'm telling you.
Well, I think the good news is I don't know if the price of that pot roast is going to come down, but I do think there are other things we're buying that will start coming down. And, that's probably good news for a lot of people who maybe feel a little bit better each month with their budget.
Excellent. And then when it comes to elections, 2024 November, do elections matter to you? Are you looking at it as closely as we look at it?
They're going to matter at some point. Generally, the election year, there's not a really strong pattern in how markets do. So the third year of an election cycle, which of course was last year, tends to be a strong year, and that played out. I think if you look at what investors have typically done, they don't start to focus on it until the conventions later in the summer. So I do think there's going to come a point, maybe about 6 months from now, where the market's going to start to focus on it. I'd say right now most investors are more concerned about what the Fed's doing in the next labor market report than what's going to happen in Washington. But that will change as we start to get into the summer.
Well, outstanding. I'm always nervous when you come on because this is big stuff we're talking about, but you make it sound wonderful. And it's been such a pleasure having you back on, Russ. And he's from BlackRock's Global Allocation Fund. You're one of their portfolio managers. And we got to have you back because, the money is so important to everything we do.
Oh, Veronica, thanks for having me, and love to come back anytime.
All right. Well, we'll be right back on Veronica Live.